Welcome to TMS Insights. Today we're going to give you a bit of a wrap up of some of the last part of reporting season. We'll also get a fair piece of macro because there's a lot going on in markets at the moment. No doubt we've seen quite a bit of selling in the last few weeks and a lot changing. So we'll get across that. But let's just jump in to some of the reports to wrap up the ASX and reporting season. Let's go to a big Australian, BHP, Ben. Really good result, and the stock did rally before this recent sell down.
Yeah, very strong, and for the first time in BHP's history, the profits from its the copper division overtook the iron ore profits, and copper, of course, is where everyone's wanted to be up until about a week ago. But you know that's been a great effort by BHP. It's re-rated onto a higher multiple, and probably if you're looking for copper exposure, this one's given. The other options out there are single mine companies with a lot of mine risk. BHP is the place to be for copper.
Yeah, no, great stuff. So that was really good to see.
And the iron ore price has been good as well. It's back over $100.
Of course, yeah, no,
and that quietly.
But from a sense of the market, they welcomed BHP back and been frozen out for the last few years, but it was back in town, so it was good to see and healthy for the market. A couple of other stocks that have been doing it a bit tough, Light and Wonder. The results, again, were solid, and again, we saw some relief, but the stock's volatile, isn't it?
It is. I think we've seen with just in the last week to 10 days, it's probably stocks which are seen as maybe being more discretionary spending in nature have definitely been hit a bit harder than others. But Light and Wonder's result...
Improved gaming, of course.
It depends how you look at it. Light and Wonder was a 3% beat versus expectations. I think the only negative was that they didn't give longer term guidance, which they have historically.
Yeah.
But they guided for strong growth in the year ahead. Yeah. So stock looks cheap, as does Aristocrat.
Good trading stock, that one, isn't it? It's bouncing around a lot.
Yeah.
Mineral Resources has been one of those. We've had BHP before, but that's had an incredible year and a half, hasn't it?
It has. And a lot of the governance issues, I think, have been broadly dealt with, which is great. And the market got to focus back on the core fundamentals of this business, which look a lot better. And the big thing is the de-gearing that's happening in the business. They'll pay about $1.5 billion of that debt off within the next 6 months, potentially.
And that was the primary issue that drove the stock down. So,
exactly. The lithium price is still very strong off its base, and of course the iron ore price is still over $100, and it feels like Onslow's really dialed in now. It's actually operating above nameplate capacity, so the business is back humming along.
Yeah, the performance of Seek has, the result was good, but again, they've been sold off in this market.
Yeah, a beat on expectations, but we've seen all three marketplace businesses have been sold off, Carsales, Seek and REA.
Yes.
Again, it's around all these AI concerns. We've seen it in every marketplace business around the world. I feel like all three CEOs locally did a great job at explaining why the proprietary data that they own will be very hard to
opportunity.
Be emulated. So, look, strong guidance. They actually upgraded their guidance to the top end of their previous guidance range, and business is in great shape.
Yep.
Bit of unemployment stuff coming through, though. We might talk about that.
Yeah, we mind the macro piece. So that can be a positive or a negative, depending on how it plays out. WiseTech has been positive and negative at different times, and again, I know that there's so much to break down here, really.
Yeah, and again, we could spend 10 minutes.
Yeah, we could too. And again, there is some different ways that markets are seeing that now. I think that perception, but in terms of share price, it's certainly still right down that low end. Overall, the result, they had enough in it to keep people satisfied, and the bulls are strong on their case.
Yeah, look, I think it's it looks like they'll come in at the top end of their guidance. The big news out of WiseTech was actually non-financial. Well, it will be financial, but was the laying off of 40% of their staff. And then we saw the night or two after Block came out and announced they're laying off half of their staff.
That's talking about unemployment, aren't we?
Right. Well, yeah. I mean, that's what I was getting to.
And this was the back of that Citrini report, which has been the AI worries that have shaken through markets. And that was the one for people who didn't see it, had the forecast, though we don't want to put any attachment of truth to this, of US 2028 unemployment hitting 10%, which worried people. And again, on the back of the job losses AI would create.
Yeah.
It never talked about the opportunity sets properly, I don't think. So it wasn't a complete document.
And it was
written
from
by a
a
short seller.
firm that no one had ever heard of before.
Yeah,
It was
that's
amazing how much attention it got.
Yeah.
But look, I'd say, Jez, WiseTech was a great result. We spoke about these software businesses on an Insight about a month ago,
did,
and we spoke to Bobby Adzani just before it. And one of the things he said will happen in the next couple of years is the operating margins of these technology businesses will go through the roof, in his own words. This is what going through the roof looks like, unfortunately, potentially, if you work there. But
job losses equate to margin expansion.
Right. And if AI can do the job, it's things are changing and quickly. I'll just give you a stat that Richard White said on the call of WiseTech. He said that with the AI embedded features that are now being released in CargoWise, he believes that the clients of WiseTech will be able to remove 30% of their workforces in the next 2 years. Yeah. Those clients currently employ about 10 million people when you combine them. So that's, there's...
It's very high level stuff, but it does get you thinking, doesn't it?
It does. It does.
So a bit to be wary of, but not negative, because opportunity exists around every corner.
If you put your investing hat on, if these companies can keep generating the same amount of revenue, but their cost base halves, what's the share price going to do?
Yeah. Fisher and Paykel Health
had a great upgrade. They didn't report.
No, but
but they had another upgrade. That's the third in 18 months.
And this is one of the few stocks really near its top end. It hasn't come off much at all.
It hasn't. And, I'd call out like ResMed and Fisher Paykel being two companies just in an upgrade cycle where they've held up well, but they would have done a lot more if they weren't in the environment we're in at the moment. And they're the sort of things you want to look at buying at the moment, are the companies that aren't getting the results that they should deserve.
Right, yeah. No, it's well said. And Wesfarmers, obviously, we've known this one for a long time. It's a mega company. It's had a really strong year.
Really
did pull back after its result. The market wasn't entirely satisfied with it, but there's a lot to like about it. And again, it's one of our favourites.
And, the Bunnings result was good, but this was always going to be a bit unspectacular versus the earnings multiple it was trading on.
Yes, that's true.
And we have seen this trend here, and it's been driven by what's happening in America, where the sort of the safe as houses businesses have re-rated on their multiples. And the poster child for this in America is Colgate, which is often seen as a barometer of risk on, risk off. And that's trading on a P of 45 times profit at the moment. And Wesfarmers is a better business than Colgate. It's got the lithium division, which no one's talking about.
A piece of the puzzle, but again, this multiple remains lofty, and it probably will. But the part here is talking now macro. Let's get into that, because the ASX is down roughly 9% from its peak. The S&P 500 is only down less than 3%. But that's a material fall in the Australian market. Like you said, it hasn't been equally distributed. It's happened against more of the high growth stocks, and some of the leader stocks actually haven't been beaten up much at all. And it's moving around quite a lot. Let's talk oil price. Let's talk currency. Let's talk bonds, and let's put a picture of what's going on for everybody, Ben.
So I guess the very recent catalyst has obviously been this Iranian invasion, which sort of surprised, I think, everyone. And it's also probably surprised everyone because the markets initially were fairly unfazed by this, and they've gone from that to, particularly over this weekend where it's really kicked off, to a view that this could be the case for longer. And it's hard to believe we're talking about this in Australia in 2026, but there is a concern out there in the market about fuel shortages, which would cripple the economy if they really were to take hold. We saw it last in the 1980s, and the impact on inflation that could have, and then the impact that's having on the bond market,
And at a time when inflation isn't under control in this country, we know we've got a rate of inflation well above our trading partners. And it hasn't looked like it's coming down. So it's not a good time, because it's a nasty thing when it gets embedded in your economy. So that explains the underperformance of the Australian market. And yet we've got a very diverse. I mean, the economy, the market now looks so different to the early '80s.
Yeah.
When that last happened, it should be able to withstand that a lot more. But again, we don't produce a lot. We don't refine much in Australia,
And we don't store a lot.
and we don't store much. So we are vulnerable to these cycles when they come. Historically, investing works well in geopolitical events when you buy after big sells.
Yeah.
And we've seen a substantial fall already. Geopolitical things do tend to come and go.
Yeah.
Banking crises are the bigger things that liquidity issues, debt. That's not the current discussion. So, though it may feel, valuable to read newspapers, and you don't want to get your sense of the investment worth of a market or stocks on the back of headlines based on geopolitical events in the Middle East.
Totally. And how many of them have we seen? And I think none of us know how long or how this plays out. So it's a guessing game. But we do know that Donald Trump campaigned very aggressively on not getting involved in wars outside of America. And I'm sure in his mind this is not something that seeps into the economy. It would be a disaster for him going into the midterms. But the question is, can he extract himself in one piece? And that's the uncertainty of that is what's driving down share prices at the moment.
So there's a lot going on there, and we've obviously got to keep a breadth on it, but invite everybody to obviously keep in touch, ask questions if you have them. But again, there's a lot of value that wasn't there now appearing. So,
yeah, absolutely.
Well, that's all we've got time for today. We look forward to bringing you another insights later in the month.